Company that I chose for this presentation is the Volvo Car Belgium NV. I will be telling you some more about the return on equity, return on assets, quick ratio, current ratio, cash coverage ratio, and finally I will give you my conclusion if it's interesting to invest in this company. Return on equity is a measure of financial performance calculated by dividing net income by shareholders' equity. ROE is considered a gauge of a corporation's profitability and how efficient it is in generating profits. As you can see in the graph, Volvo's ROE dropped in 2019 but went back up in 2020, where it reached 15.30%. This is a really good number to have. Return on assets is an indicator of how profitable a company is relative to its total assets. ROA gives a manager, investor, or analyst an idea as to how efficient a company's management is at using its assets to generate earnings. Higher ROA indicates more asset efficiency. In the case of Volvo, its return on assets has been rising for the past 3 years, which is really interesting for future investors. An ROA that rises over time indicates the company is doing a good job of increasing its profits with each investment dollar it spends. The quick ratio is an indicator of a company's short-term liquidity position and measures a company's ability to meet its short-term obligations with its most liquid assets. The higher the ratio result, the better a company's liquidity and financial health. The lower the ratio, the more likely the company will struggle with paying debts. The quick ratio in this case is not so good. Volvo has not been able to pay off its current liabilities with only its quick assets. The chart is also not going in a good way as it has been decreasing in the past 3 years. Current ratio is a liquidity ratio that measures a company's ability to pay short-term obligations or those due within 1 year. It tells investors and analysts how a company can maximize the current assets on its balance sheet to satisfy its current debt and other payables. Volvo has a current ratio of 0.89 in 2020, which means it had for every €1 0.89 cents available to pay for the debt at the time. A coverage ratio, broadly, is a metric intended to measure a company's ability to service its debts and meet its financial obligations, such as interest payments or dividends. The higher the coverage ratio, the easier it should be to make interest payments on its debt or pay dividends. The trend of coverage ratios over time is also studied by analysts and investors to ascertain the change in a company's financial position. If the ratio has been gradually declining, it may only be a matter of time before it falls below the recommended figure. This decline is also happening at Volvo, which is not that interesting for future investors. For my conclusion, I would say that it's not so interesting to invest in Volvo Car Group at this moment. Some of the ratios that I discussed are interesting for investors, but they are not interesting for those investors because of their low numbers at the moment. I would recommend waiting a couple of years and look back in a couple of years to see if they have risen or not.